Question 24. An employee earned $43,600 during the year working for an employer when the maximum limit for Social Security was $117,000, so he didn't go over the limit. The FICA tax rate for the Social Security is 6.2%, and the FICA tax rate for Medicare is 1.45%. The employee's annual FICA taxes amounted to what? Well, it would be the wages of $43,600 times the tax rate, and you can do this lots of different ways, but the answer key chose to take 0.62 and add to a 0.145, which looks like it's going to be 7.25. That percent times 43.6 would give you $3,335.40 total FICA taxes for the year. Question 25. Portia Grant is an employee who is paid monthly. For the month of January of the current year, she earned a total of $8,838. The FICA tax for Social Security is 6.2%, and the FICA tax rate for Medicare is 1.45%. The FUTA tax rate is 0.8%, and the SUTA, that is, FUTA is federal unemployment tax and SUTA is state unemployment tax rate of 5.4% is applied to the first $7,000 of employee pay. The amount of federal income tax withheld from her earnings were $1,466.47. Her net pay for the month would be what? And then round intermediate calculations to 2 decimal places. So the formula basically is net pay is going to equal the gross pay minus federal income taxes minus FICA Social Security minus FICA Medicare. You ignore the SUTA and the FUTA up here because those are taxes that only the employer pays. Employer only pays the FUTA and the SUTA. Alright, so to get the net pay, you want to take the gross pay of $8,838 minus the federal income tax withheld of $1,466.47 minus the $547.56 of Social Security and minus the Medicaid or Medicare taxes of $128.15. You combine all that together and you get net pay of $66.95.42. And here's the calculation for the Social Security. It'd be $8,838 times 0.062, $547.96, and Medicare would be $8,838 times 0.0145, which would be $128.15, and that's it. Number 26, Portia Grant is an employee who's paid monthly, and it looks like this is exactly the same problem except just a different set of numbers. So use the same basic formula that you did before. You're going to have the, let's see, no, I guess they are asking something different here. They're asking what is the total amount of taxes withheld from Portia's earnings. Well, let's see. Let's go back and start again here. She's paid monthly. For the month of January for the current year, she earned a total of $91.38. The FICA taxes are 16.2% and Medicare is 1.45%. FUTA and SUTA, you basically ignore those because, like I said, the only employer pays those. And the amount of income tax withheld from her earnings would be $15,627. So what's the total amount of taxes withheld? Well, it'd be the federal income tax of $15,627 plus the Social Security tax of $566.56. And the way we calculate that would be the gross pay times the tax rate of 0.062, 566.56, and then you want to add to that the FICA Medicare tax, and that'll be based on 91.38 times 0.145, which is 132.50. So the two FICA taxes along with the federal income tax means she's going to have total taxes withheld of $22,1535. Number 27, the current federal unemployment tax rate is 0.8%, and the SUTA or state unemployment tax rate is 5.4%. Both tax rates apply to the first $7,100 of an employee's pay, assuming that employee earned total wages of $9,100. What is the amount of total employment taxes that the employer must pay on the employee's wages. Well, you don't pay it past $7,100, so you can ignore some of this. So the calculation is going to be 7,100 times the two tax rates of 0.8% and 0.054%. Add those two together, multiply that times 7,100, and the total amount of the taxes that the employer should be liable for would be $440.20. Question number 28. An employee earned $3,400 working for an employer in the current year. The current rate of FICA Social Security is 6.2% on earnings to $117,000 maximum for the year, and the rate for FICA Medicare is 1.45%. The employer's total FICA payroll tax for this employee would be what? The employer is responsible for the Social Security and the Medicare, and it looks like because they have to match whatever the employee has to pay, they have to match it, plus they have to pay those SUTA and FUTA amounts, but this doesn't apply to this problem. So $3,400 times the Social Security rate of 0.62 and the Medicare rate of 1.45. Add those two together, multiply that times the amount the employee earned, and the employer's liability for this FICA tax would be $260.10. Number 29. On April the 12th, Hong Company agrees to accept a 60-day 10% $5,600 note from Indigo Company to extend its due date for an overdue account. What is the journal entry needed to record the transaction by Indigo Company? Okay, Indigo Company is going to get rid of an old deadbeat past due accounts payable. So they're going to debit accounts payable $5,600, and they're going to get instead a replacement for a notes payable for $5,600. And it looks like they're trading their old accounts payable that was past due for a note, and now they're going to start paying interest on this, since they now have looks like a 10% interest rate on this. Number 30. On April the 12th, Hong Company agrees to accept a 60-day 8% $9,300 note from Indigo Company to extend the due date on an overdue account. What is the journal entry needed to record the payment of the note by Indigo Company on the maturity date? So the entry is going to be a debit to notes payable for $9,300 and a debit to interest expense for $124, and they're going to credit cash or write a check out for the sum of these two, the principal and the interest, for $9,424. And the calculation involved in all this would be as follows. The interest expense that we figured up here of $124 is basically $9,300 times 8% times 60 days over 360, which equals interest of $124. And the company's going to have to pay not only the principal back, but also the interest of $124, principal from $9,300, or a total of $94.24. Question number 31. A company used straight line depreciation for an item of equipment that cost $15,550. This equipment also had a salvage value of $3,400 and a 6-year useful life. After depreciating the asset 3 complete years, the salvage value was reduced to $1,555. Remember, it was $3,400. Now it's $1,555. But its useful life remained the same. Determine the amount of depreciation to be charged against the equipment during each of the remaining years of its useful life. Well, anytime you have a change in either that asset's life or its salvage value, the first thing you do is you bring things up to the point where the change is made, and then you figure for depreciation and figure out what the book value is at that point, and then make the future depreciation or the remaining depreciation based on that new total. So let's do that. So the original cost of this asset was $15,500 with an original salvage value of $3,400. And when you subtract these two out, you get what's called the depreciable amount. You're going to take that and divide it by the original life of 6 years, up here 6 years, and multiply it times 3 because 3 years have gone by. So therefore, you have depreciated this asset $6,075 to the point of where things changed. Now, the remaining life will be depreciated as follows. You take the original value of $15,550, subtract off the amount we've depreciated to this point of $6,075 minus the new salvage value of $1,555. All of that is crunched together and then divided by 3, which is 3 years remaining life. And now from this point on, after 3 years, you will depreciate this item on a straight line basis, which will be $2,640 per year.